Hello, everyone. I first want to thank you for spending your time with us on this webinar today. My name is Katherine Grout. I'm an attorney at the Copenbarger law firm, practicing in our business and tax department. I am primarily a business attorney. We have dedicated tax professionals and accountants that I work closely with. And today, as the title shows, we're talking taxes. So some of you may still have some PTSD. We just passed tax day. If you missed it, I'm really sorry to be the bearer of bad news, but that's not great for you. But for the rest of you, why is this relevant now, you might be thinking? Because today we're talking taxes for business planning, the stuff you need to do well before tax day. Some logistics, I won't be answering questions live, but if you put them either in the chat or Q&A if it's open, our team is going to make a note of them, and then we'll follow up with you on your question, or if you would like to schedule a consultation with any of our attorneys, please feel free to make that note, and our team will follow up with you to schedule that. A bit about our firm before we dive in. If you are new to Copenbarger, we have a number of attorneys across several practice areas, from estate planning and estate administration to probate and litigation, as well as my realm, which is business law, corporate governance, and also tax planning and accounting. Our teams and our departments work together to provide you with holistic planning, protection, and defense of your legacy, and help you build your ideas, your wealth, your passions, so that you can have a greater impact on your community and your family. One of the key benefits of Copenbarger is that holistic planning and protection. We all work together to provide you with the best solution for your goals. At Copenbarger, we do pride ourselves on our client care and service. Of course, we could not provide our service with such high level of care without our incredible staff. Our staff is the reason why we're able to serve you and serve so many clients as we have for as long as we have. The people pictured here help make sure that your questions get answered in a timely manner. They help and make sure that the entire process flows smoothly and efficiently, get you scheduled like our staff on the call today as well. Another factor of our firm that helps us provide this exceptional care is that we have offices all over the state. For most of our clients, we have a physical location that's close to them. And many of our attorneys can travel and actually meet our clients at any of these locations. So for example, I'm out of San Jose, but I can travel and meet clients in any number of these offices. For those who may prefer or have difficulty coming in person, we also provide our services remotely over Zoom or phone, and we can accommodate your needs and preferences. All right, so for today's agenda, we'll start with some definitions and fundamentals, including what taxes apply to businesses. So we're talking taxes, but in the business perspective. Then a bulk of our discussion will be looking at how those taxes are impacted by your business type and taxation elections that may be available to that business type. Lastly, we'll take what we've learned and we'll close with some helpful considerations for many business founders. Consider this content to be like a 101 level class. We're barely going to scratch the surface. If at any time you either want to drop off or if you're watching a recorded version and you want to skip ahead, please feel free to do so. This content is for you. Use it in a way that's helpful to you. This presentation is probably going to be about 40 minutes. So just keep that in mind and sit tight and we'll get through this. We'll get through taxes together. On that note, a brief disclaimer before we dive in. As legal and tax professionals at Copenbarger, we do need to stress that this information that I'm presenting today is general and it's for education purposes only. Your situation is always going to be unique to you and require legal, accounting, and tax advice that is specific to you. So please take the content today that you learn as a jumping off point to help inform those discussions with your advisors. Now we're going to start in the first bucket for today. Let's start with some of the basics. We'll cover some definitions, and then we'll go over what types of taxes most businesses encounter on a really high level. So in this section, we're going to define income tax, estimated tax, self-employment tax, and employment tax withholdings, and then look at the California franchise tax, really important tax in this state. So income tax, what is this? We're really familiar with this on a personal level. So it's the tax that a business or an individual earned or received as income. Most businesses must file an annual income tax return. The way income tax is calculated is going to depend on your business structure. So we're going to unpack that a lot today. For example, corporations are taxed separately, while sole proprietors report their income on personal tax returns. Now, let's also highlight if you're self-employed or your business doesn't withhold taxes, you're likely required to pay estimated taxes quarterly, and this can be overlooked by a lot of business owners. These payments cover income tax as well as self-employment tax, we're going to get into. Underpayment can lead to penalties, so accurate forecasting is key. When are these estimated taxes due? The general payment period for most businesses it's broken up into 4 quarters, with Q1 representing January, February, and March earned income, and that is due April 15th. Q2 represents income earned in April and May, and that's due June 15th. Q3 is another 3 months, June, July, August, and that's due September 15th. And then Q4 is the last 4 months of the year, September, October, November, December, and that's due the following year, January 15th. Now, this is going to be different for businesses with a fiscal year, which we'll talk more about later as well. Then self-employment taxes, which I just mentioned. This covers Social Security and Medicare contributions. So who's looking at this tax? If you're a sole proprietor, so you're a business, maybe you haven't even registered your business, maybe you just have a local business license, or if you're a partner and you're part of a partnership, any of various flavors, or if you're an LLC member, or a member is the terminology for an owner and an interest of an LLC. Now, if you need a refresher on any of these business types, I did a webinar a while back. There's also a recording available. I'd revisit that and look through and run through the different business types as well. So if you're a sole proprietor, partner, or an LLC member, you're going to be subject to this tax. Currently, it's around 15.3% of net earnings, and it's something, like I mentioned, many new entrepreneurs overlook. If your business has employees, you must separately you must withhold and pay Social Security, Medicare, and federal unemployment taxes a little differently than the self-employment. This includes both employer and employee contributions, and proper payroll systems are essential to ensure compliance with this. For all of these, the IRS does have a withholding calculator to help you account and forecast for your estimated taxes. There's a lot of other calculators available online as well. I do recommend often a lot of them, but in conjunction with an advisor. Now, let's talk briefly about the California franchise tax, something nearly every California business owner needs to be aware of. In California, most business entities must pay an annual franchise tax simply for the privilege of doing business here. For LLCs, limited liability companies, and limited partnerships and limited liability partnerships, that means a minimum tax of $800 per year, even if the business makes no money. On top of that, if your LLC will make more than $250,000 in a year, you will have to pay an LLC fee, which is tiered based on annual income. On the low end, just to give you some perspective, so LLC owners are required to pay this $800 minimum annual tax. If they exceed $250,000 a year, they pay an additional tiered fee, the LLC fee. On the low end, if you're between 250,000 but less than 500,000, it's, just to give you a sense, a $900 flat tax. And up to the highest tier, if you earn an annual income of 5 million or more, this tax is just under 12,000. LLCs must estimate and pay the fee by the 15th day of the 6th month of the current tax year. 15th day of the 6th month of the current tax year. This is reported on Form 568. Now, C corporations pay either 8.84% of their net income or the $800 minimum, whichever is greater. S corporations, on the other hand, pay that 1.5% of net income plus the minimum. So very different. And we'll talk about these two different taxation structures a lot more throughout this presentation. So hopefully this will become very familiar to you. There's one small break, and this is only available to C Corps, not S Corps. The first year a C Corp is founded, they are exempt from paying that $800 minimum. This does not apply to any other business type. That's a lot, I know, but we can definitely work through. There's a lot of nuance and tax is challenging. Lastly, I just want to point out that state and local governments may have some additional taxes, such as gross receipts tax or a business license tax, or possibly you're operating in another state as well as California, and you may be subject to another state's franchise tax if it applies. These taxes are ones that vary by jurisdiction and business type. So be sure to research first local requirements thoroughly and then industry as well. So depending on your type of business, you may also be subject to an excise tax. Excise taxes are taxes that apply to specific goods and services. Think like fuel, alcohol, heavy highway vehicles. Certain industries, goods, services may experience additional taxes that are an obligation of the business, different than a sales tax. If your business falls under this category, you'll need to file additional forms and track taxable activity closely. Okay, so that was the definitions and intro section. Now let's look at how these types of taxes apply to business types and taxation types or taxation elections. This section is mostly going to look at how income tax varies, but also self-employment tax and Social Security and Medicare tax and withholdings. Your choice of business is going to impact how your income is taxed. This decision impacts your tax liability. It impacts paperwork, deadlines, tax filing forms. The next few slides will help explain how certain business taxes are handled for different taxation structures. So a bit more terminology, disregarded entities. What are disregarded entities? There are sole proprietorships, so individual owners that may or may not have registered any actual business, but they are operating a business and collecting income on their business. There are also single member LLCs. These disregarded entities are not taxed separately from their owners. Profits and losses are reported on the owner's personal tax return, typically via Schedule C. This structure is simple, but it also, the downside is it offers few protections and limited tax advantages and flexibilities. Let's look at that self-employment tax first. So Social Security and Medicare when you're self-employed. For a disregarded entity, you're paying this tax as both the employee and the employer. You add, excuse me, you add both percentage portions. So for 2020, what this looks like for 2024 and for 2025 coming up, Social Security was 12.4%. That's 6.2% from employer, 6.2% from employee. You pay both. For Medicare, it was and still is 2.9%. That's 1.45% employer and 1.45% employee. Now, 15.3% total is what you're looking at for your self-employment tax. That's 15.3% of business profits. A small asterisk here. There is a federal tax deduction for paying self-employment taxes, which makes this closer to 14%. So keep in mind that there may be deductions that apply. What's your federal income look like with a disregarded entity? Same as your individual, you have, federal income brackets between 20 and 36%. However, another asterisk here, when you calculate it, you can take roughly a 20% reduction in the total business profits. And this is for the qualified business income deduction. So another deduction that applies. What's the California state tax income rate? Same as your individual, you have brackets from 1 to 12.3%. Now let's talk about partnerships. So partnerships and multi-member LLCs, these are considered pass-through entities, meaning the business itself doesn't pay federal income tax. Instead, the income passes through to individual partners who report their share on their personal tax returns. To give you a sense of how this impacts what we just discussed, Social Security and Medicare taxes, generally, it's going to follow the same rules as the same percentage, same process and calculation as sole proprietor, but the profit is split between your individual partners. So on an individual level, you'll see that you're actually paying less but that's only because the profit is also shared. And then again, same as the disregarded entity, there is a federal tax deduction for paying self-employment taxes. The business, so pass-through entity businesses, we're looking at partnerships and multi-member LLCs. The business must file an informational return, and each partner receives a Schedule K-1, which breaks down their share of income, deductions, and credits. Each partner is responsible for paying taxes on a portion of their income, regardless of whether or not that business actually distributed money to them. So that's what is often called phantom income, and it's often a surprise to many business owners. So regardless of whether that is distributed to the partner, you're going to pay taxes on it. Pass-through taxation avoids double taxation, which is something that corporations face. We're going to talk about in a little bit. And partnerships also offer a lot of flexibility. Partnerships and LLCs offer a ton of flexibility. For example, profits Profits don't have to be split evenly. They can be allocated according to the partnership agreement if you're a partnership, or the operating agreement if you're an LLC. However, for partners, it's going to require a lot of tracking of basis and capital accounts. This structure is really great for businesses with multiple owners who want flexibility and less formality than, say, a corporation. Okay, now we're going to go ahead and talk about this S Corp election. I say S Corp election. Commonly in the vernacular, we hear it just referred to as an S Corp. And it gets conflated with an actual legal entity called an S Corp. The S Corp is a tax distinction. It is a signifier and it's an election that you file with the IRS to be taxed as an S Corp. From a tax perspective, it's a certain type of entity, but from a legal perspective, or from the formation and from business and entity formation, there is no such thing. It's specifically a tax election. And so when I say S corporation, keep in mind, it's an S corp election, tax election. It's a tax type. So S corporations, they're a special kind of pass-through entity, but with some additional benefits. They have unique advantages, especially for tax planning. An S corp, like I started to mention, begins as an LLC or a corporation, and then you file IRS Form 2553 and elect this S Corp status. This election allows the business to pass income through to shareholders and avoid double taxation, like most corporations or many corporations would experience. And that's similar to a partnership, but then with one big benefit, several big benefits, but one big benefit, S Corps offer, or S Corp owners can avoid self-employment tax on distributions. So let's look at this a little bit more. It kind of sounds more complicated than it needs to be, but when calculating tax, the business profit for an S Corp is split into two buckets: reasonable compensation of owners, owners being shareholders, or in the case of an LLC, it could be a member, and then distribution. Now, the distribution really may or may not actually be distributed. So it's just the remainder of the business profit, really. It could be kept and held in the business, or it could actually be distributed. That salary or reasonable compensation is subject to income and payroll taxes. So the 15.3% for Social Security and Medicare tax, you are only taxed on that reasonable compensation portion of the business profits. And as a result, commonly, you'll end up paying a lot less in Social Security and Medicare taxes than if you were a disregarded entity or a simple pass-through entity. Now, for federal income tax, how does an S Corp, how does it look? What's the variability here? You will add that reasonable income and distribution. So you're looking at the whole pot. You're looking at all business profits. However, you can take, for the same qualified business income deduction, you can take a roughly 20% reduction in the total business distributions. You can take a roughly 20% reduction. And that's so we looked at, let me reiterate. So we looked at breaking up the business profit into reasonable compensation and then distributions. You're taking the 20% reduction on that distribution portion. This structure in many cases can offer significant tax savings, but here's the catch. It does come with a lot more IRS scrutiny, and there's a lot more limitations, restrictions, and eligibility requirements. First, the IRS watches for unreasonable salaries, and the business must file the form 1120S and issue Schedule Ks to shareholders. Also, S corps are limited in who can be a shareholder. There's a lot of rules and restrictions behind them, so you may or may not be eligible for it, but it's something that is worth investigating further. So while the S corp offers a smart way to split income between salary and dividends, it requires tight compliance and planning ahead. Now let's look at corporations. When I talk about corporations here, I'm talking in the context of C corps. So it is a business that has formed as a corporation and has not elected S corp taxation. In other words, they're called C corps. These are treated as completely separate tax-paying entities under the law. A C corp pays income tax on its profits, currently at a flat rate of 21% federal, the federal tax rate. If it then distributes profits to its shareholders as dividends, here's the issue. Those shareholders also pay tax on that as income tax. This is that double taxation that I mentioned earlier. So you're paying tax up front and then tax in the distribution. It may sound, or the entity, I should say, is paying tax and the shareholder is paying tax, but when you're both, it hurts double. It may sound kind of like a lose-lose to many. So why do we have C corps? C corps do offer a lot of benefits that can make them the right choice for certain businesses, but usually they're less popular for small businesses. They're common and ideal for high growth or growth businesses. If you need to have unlimited shareholders, if you issue multiple classes of stock, if you need to attract VCs or institutional investors. They also have some additional benefits. They offer deductible employee benefits like healthcare and retirement plans. So because of their double taxation, and in a separate webinar, I talk all about how they are more arduous to just maintain. There's more filing requirements. There's more corporate formalities. So because of the double taxation, more compliance mandates and corporate formalities, this business and taxation type is really typically more suited for larger businesses or soon to be larger businesses. But again, please always consult directly whichever advisor you're talking about. So legal advisor, accountant, tax professional, get the whole picture first before you move forward. And again, if you have any questions, I won't be taking questions in the presentation itself because we have a lot of content to get through, but please leave them in the chat or go ahead. We'll drop an email link at the end of this and we'll follow up with your questions and comments after the presentation. Thank you. Okay, so we talked about, I just like to use this as a recap point. So because we talked about S corps and C corps and they sound really similar, but they're really taxed very differently. From a very general perspective, so let's do a small recap. If your business plans to reinvest profits back into the company or attract investors, a C corp is often better suited. Flexible ownership, variable stock classes. On the other hand, if you're a small business owner looking to save on self-employment tax, an S corp may be a potential way to lower your overall tax liability. You should always consult a tax advisor. Each option has implications for payroll taxes, retained earnings, fringe benefits, and how you handle losses and deductions. So there's a lot of variables that are unique to you, your goals, your business goals, your ownership structure, how you plan to grow should all factor into the decision of which business to form and which tax election to choose. Another sort of recap slide is a side-by-side comparison here. So we've laid out this chart comparing sole proprietorships, partnerships, LLCs, and corporations. Kind of serves as a summary here. It's hard because there's not a one-for-one. We kind of have to unpack one-for-one ratio. We kind of have to unpack each option. But generally speaking, sole proprietor and single member LLCs are disregarded entities typically, unless an LLC is elected otherwise. Those disregarded entities are the most straightforward to operate, but they offer limited tax flexibility, planning options. For partnerships and multi-member LLCs, the incomes flow to the owner's personal tax returns via K-1s. This taxation offers flexibility in how profits are distributed, but they can be more complex and you got to do a lot more tracking of basis and handling special allocations. For S Corps, profits pass similarly, profits pass through to owners via K-1s. This taxation election offers tax advantages, but comes with eligibility restrictions and stricter rules like we discussed. And then C corporations, on the other hand, pay tax at the corporate level, currently 21%, and shareholders pay tax on their dividends received, that double tax. So they are the most complex from a compliance perspective, but they also provide the most flexibility in ownership structure, fundraising, and benefit deductions. So this comparison is meant to help you start thinking about the big picture, how your choice of entity will affect not just your taxes today, but also your growth, maybe your financing, the life and potential exit of you and your business. Another thing I want to recap is just what these forms look like by taxation structure. So filing deadlines and IRS expectations, there's so much more to unpack here. So this is really high level. Sole proprietorships and single member LLCs are required to use a calendar year. So here's where we're going to start to look at calendar years versus fiscal years. Why is this important? Some entities can elect or apply in some cases for a fiscal year. Disregarded entities cannot. They have to follow the calendar tax year. Is a Schedule C form. It's due on traditional tax day, April 15th. C corps that have elected or defaulted to operate on a calendar year, so either they're by default, they didn't apply for a different fiscal year. So a C corp is also the same. It's going to be due on tax day, April 15th, and that's form 1120. Now, C corps are the one type of structure that is most commonly eligible for a fiscal year option. If a C corp elects for a different fiscal year, meaning the end of their fiscal year is not December 31st, then your form 1120 is going to be due on the 15th of the 4th month following the fiscal year end. So it follows the same period, but it just phase shifts depending on when your fiscal year is. Pass-through entities, partnerships, multiple member LLCs. Most partnerships, they're going to be required to follow a calendar year as well, and their Form 1065 is due March 15th. If they have, in certain situations, multi-member LLCs may be eligible and get approval from the IRS for a fiscal year end, then that form is going to be due on the 15th of the 3rd month following the fiscal year end. So just 1 month shifted. And then S Corps, same general rule, but you're filing a Form 1120S. Okay. That's a lot. It's a lot. And there's a lot of nuance that we can't cover. So a lot of the rules and regs that I've gone over are kind of the general rule. There may be some exceptions that apply. So please keep that in mind. You need to have more detailed discussions with your advisors on a personal level about your specific situation. Last big section we'll look at are some tips and strategies for business founders. So what do we do? When we launch a business, there's a couple of key tax-related steps that every entrepreneur needs to take right from the start. So first, and some of you, if you're already business owners, may be familiar with this, and I certainly hope you are. You'll need to register your business with the state, and then once you've registered, you apply for an EIN number through the IRS. You'll need this EIN to pay taxes, hire employees, open a business bank account, and file returns. So this is when you have a registered business. We're not looking at, now we're outside of the scope of sole proprietors. And please do keep in mind that if Copenbarger helped or does help you form your business, this is a process that we take over. We help you do this, we do this for you, or help you depending on the engagement itself. But typically we apply for all this for you. Next, it's essential to understand your tax responsibilities at all 3 local levels. So local, very local, state, and federal. For example, in California, we already talked about the California franchise tax, but there may also be city business license taxes. And if you're operating in another state, you're conducting business there, you may be subject to those other state taxes. They may have a franchise tax as well. And at a federal level, you'll need to determine if you owe income tax, self-employment tax, employment tax or excise tax. So all the taxes that we started at the front of this. Lastly, you'll also want to choose a calendar. You'll choose your tax year, assuming that you're eligible to elect. You'll either have a calendar year, or for some businesses, like we discussed, you can choose a different fiscal year. For those that opt for a fiscal year, it's typically so that it aligns better with your business cycle. Your chosen tax year is going to affect deadlines, like we discussed, planning strategies, and also how your income is reported. So that's usually the motivation behind picking or selecting a fiscal year. Oops. Once you're up and running, being proactive about your taxes is the smartest way, or is the best way that you can protect your business. It's important to keep accurate and consistent records. This means keeping all receipts, invoices, bank statements, and logs as consistently, and preferably in a digital or searchable manner at this point. This ensures that you're ready for audits. Unfortunately, we hate that word. It also ensures that you can track deductible expenses and avoid costly errors. Work with I cannot recommend this enough. Please work with a CPA or tax professional. I know I get, especially for small businesses with limited funds, the do-it-yourself method is very attractive. You really just want to get the business off and running, especially when you're still at like the proof of concept phase. But if you're in the process of investing in an actual business organization, you want to form an entity, you're already paying additional costs. That's hopefully you're past a little bit of the proof of concept stage, and you're able to let go of kind of that do-it-yourself mentality. because a qualified CPA or tax advisor can really help you stay compliant. They can help you plan ahead and even find deductions that you may not know about. So they're very valuable. They can also help you prepare for future legal or tax law changes, or perhaps your business is growing and then you need to make adjustments. They can help flag that for you early on so that you can adjust accordingly. And then lastly, technology is going to be your best friend here. QuickBooks, the most common probably tool for all of this. Even there may even be industry specific platforms that help you automate tracking and can save you valuable time. So really look into some of these software resources if you haven't already. Okay, just a little bit more left. Let's look at a couple of common mistakes and avoidable tax mistakes that can get business owners into trouble. For many new entrepreneurs, first off, like we talked about before, they may not realize that they need to pay estimated taxes quarterly, especially when you're looking at smaller or unregistered businesses, sole proprietors, or partners in a partnership. Skipping these could result in penalties and interest. So please always consult your tax advisor and calculate what you owe and when. Again, I want to plug that there's a lot of online calculators. It's best to use a tax advisor, but at a minimum, there's a lot of online calculators for this estimated tax. Another one, commingling personal and business finances. We didn't really talk about this, but one of the fastest ways to lose that personal liability protection is by commingling funds. At a minimum, it creates accounting chaos. So open up separate accounts, use a dedicated business card, and track all your transactions properly. Attribute them to the right accounts, to a specific business purpose. Another one that we see is the misclassification of workers. So if you're hiring staff, please know that you can't just choose whether they're an employee or an independent contractor. You actually have to follow what an independent contractor or an employee is according to in the state of California, California state law, which is one of the more worker-friendly states. So misclassifying someone because you're trying to avoid payroll taxes can lead to IRS penalties. When in doubt, consult a professional, or at a minimum, look at the IRS publishes guidelines on this too, so you can at least follow that. To wrap this section and just kind of do a quick recap of what we've already highlighted, structure your entity wisely. The structure you choose affects how much you pay in taxes and how you can deduct expenses. Entity choice is one of the most impactful decisions you'll make, so get advice early on. Make the right choice now. Also, deduct your business expenses correctly. Common deductions include home office, business mileage, office supplies, software. But to deduct these properly, again, you need to track them carefully and ensure that they're truly business related. Where applicable, lastly, invest in it where applicable. So this may not apply to all businesses, but invest in retirement and healthcare plans for deductions. If you have employees, look into small business retirement plan options that benefit everyone and potentially give you some more write-offs. How can Copenbarger help? Our team is business and tax. I help and advise a lot of small businesses with a lot of different business needs. Today was all tax. So we can guide you to the right entity for your business needs. It's going to be dependent on law and tax. We bring those two concepts together. We can also help you set up your legal structure. We can draft and negotiate business contracts, counsel on regulatory compliance, a number of things we didn't cover, but that are available in some other webinars that we have posted online. So go ahead and give us a call if you're starting a business or you're thinking about starting a business. You're selling or transferring, all are part of an existing business. We can definitely help out with that. Or if you're just concerned you have an existing business, but you're not really sure if you're complying with actual laws and regulations that are related to your business, we can help you. We can also help you plan and strategize how to better protect your either business assets or personal assets. A lot of this is beyond the scope of what we cover today. Those webinars that are posted on YouTube and on our website, we have several that are geared towards small businesses. Please check them out. Why Copenbarger versus, I mean, there's so many firms that you could work with, but we've been serving clients for 45 years and counting, 46 almost. We have locations all over California. We have attorneys and professionals trained in multiple areas in, like I mentioned at the beginning of this, litigation, estate planning, estate administration, business, tax, accounting. We have the ability to review your goal and not pigeonhole you into a specific solution just because of an individual attorney's practice area. We can work together. The attorneys here come together and we look at and provide you a solution that's based on solutions across multiple disciplines. And also, frankly, I think our client care is truly unsurpassed. Lastly, that's it. You hung in for the entire presentation today. Please do in the chat there should be they dropped an evaluation link. Please give us feedback. We provide these webinars to you basically on a regular basis, free of charge. Make us cater this content to what you want to hear more about. If you had extra questions in a certain area that we can potentially do another webinar on in the near future, that's feedback that's valuable to us, that helps us help you. So please, I'm going to hang here on this last slide for just a couple minutes. Please fill out that eval, put in your comments, give us feedback. We want to learn how to better serve you. And then again, I do see that we had active and hands raised. Thank you. I'm sorry that we couldn't get to them, but we will follow up after. And we had some activity in the chat too. Really good questions. I'm not going to get into specific situations, but we had some good questions come in, so I really do appreciate it. And we'll follow up with you. We're making a note of them and address your questions, whether it's we need to just answer a simple question for you today, or whether it involves a more in-depth discussion and we need to set up a direct consult with me or another attorney. We can do that. So I really do appreciate, I'm sorry I'm not addressing some of these questions, but they are good questions, and we'll get back to them. Please do email us. Feel free to email us. We have info@copenbarger.com available here. My direct email, please feel free to reach out to my direct email. It's Katherine@copenbarger.com, Katherine @copenbarger.com. We have a number of ways that you can reach us. If there's ever a question though, visit our website and peruse it. There's a contact portal there. You can also give us a call anytime. Thanks so much for sticking in, and I look forward to having some meetings with some of the individuals on this call very shortly, I'm sure. And if you haven't subscribed to us on social media, but you do like seeing these webinars pop up, and you like to follow our content, please feel free to follow us on any number of these social media websites. Thank you so much. I hope you enjoy the rest of your day, and I look forward to speaking with many of you. Thank you. All right. Have a good day.